Good day everyone. Thank you for tuning into this video. Today I'm going to walk you through one of the most important conversations in technology and investing right now, the AI bubble. We are living through a period of extraordinary market enthusiasm. Every startup pitch, earnings call and product demo mention AI. In relation to this, stock prices have reached extraordinary levels. But I want you to take you behind the headlines and show you what's real and what's all the hype about and what is actually driving the dynamics of the market. Next slide. So let's start with these headlines. Have you seen what's driving the AI boom? Well, OpenAI has been valued at 500 billion US dollars. One of the most biggest tech giants, Microsoft and everyone are investing in that. And that is one company which is a private and global at the same time. Next, AMD states a strategic partnership with OpenAI and a potential revenue of $100 billion. And Elon Musk got an approved conditional package of 1 trillion. Well, tell me about a package. Complan, that's good. Next, Berkshire Hathaway, one of the biggest financial firms, have 381 billion US dollars in cash holdings. And the recent one, SoftBank sells Nvidia for 5.8 billion US dollars. Well, all of these sort of headlines create a narrative of extraordinary wealth creation. But these can also be warning signs when sophisticated investors are taking in profits and holding on to their cash. Alright, but who are the main players in this? Well, they are called Mag 7 or the Magnificent Seven. They are Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. They are now synonymous with the AI boom. These seven companies account for roughly 30% of the S&P earnings growth. Without them, the broader market has essentially little to no earnings growth. Their need isn't just driving the markets, it's also driving the latest era of technology. Their dominance isn't probably permanent, but on a market cycle, this is probably the one that's going forward. Let's move on to what's called a circular financing. That's what Wall Street Journal calls it, which is more concerning. Nvidia invests in OpenAI. OpenAI buys computing from Oracle, and Oracle buys hardware in turn from Nvidia. It's just this is just one of the circular loops that I mentioned. But if you look at the image, it's it's a big wide map of circular financing on a broader scale. This definitely inflates revenue and profit. But no, if you closely see, there is no external value being created at all. Sort of. Not in the near term though. This inflates the top line revenue without creating real profitability. When significant portion of the revenue is circular rather than external customers, that's a major red flag and also a fundamental weakness. Moving on. Nvidia manufactures Blackwell Ultra. I mean, that's their latest offering. Supply is severely constrained by TSMC's capacity. Nvidia's current valuation assumes that the companies will spend indefinitely tens of billions of dollars on the compute. But that is contingent on AI generating sustainable and profitable revenue on a consistent basis. Let's recap. Sustainable, profitable revenue on a consistent basis from all their AI companies through their customers. And that is not that easy. And also, adoption is a big issue right now for AI. If adoption disappoints, then that would obviously crash and valuations will collapse. Moving further, this is something I learned in my bachelor's degree that's called the Moore's Law. Let's look into that and how it relates. So Moore's law states that a transistor density doubling every 2 years. Now that is hitting a wall. From 7 nanometer to 5 nanometer, it took 24 months. From 5 to 3 nanometer, 30 months. And 3 to 2 nanometer, that which we are currently, is taking 36 plus months. I mean, you can add in the yield issues and the chip fabrication industries that will add up more. If innovation slows, chip prices won't fall. Economics of AI infrastructure becomes challenged, and this does not help that the chip fabrication industry is diversifying and we are getting new ones in Texas. But that's not fully functional yet, and they are facing delays as well. So that's a whole different story. Moving further. So how does an AI company actually generate revenue? So AI companies usually have straight off the bat three different ways of generating revenue. One is through application layer. As you can see, OpenAI's favorite product is ChatGPT. They bring up latest versions and they charge users on a monthly basis and enterprises and so on and so forth. Next, you have AI as a service. These are cloud providers who charge again on a monthly basis for their AI services that they provide. And finally, you have tool aggregations. Now, here you have one company that aggregates all the relevant tools that is needed and then provides that as a service through their platform. So companies like Salesforce bundle AI into their broader platform, and then you have Nvidia, Higgsfield. All of these are used by short form video content creators, and that's a real world application. And they charge you on a what do you say on a credit basis or a generation per video basis, and on top of that, you need to have a subscription with them as well. All right, let's move on. But how is AI being adopted? Where are we right now at the customer base? So, to understand that, we need to understand the tech adoption cycle. So, tech adoption goes through five different stages: the innovators, early adopters, early majority, late majority, and finally laggards. AI is currently between early majority and early adopters. That means 15% is being used, and that leaves a total of 80%, 85% potential users, which includes personal and enterprise level, to embrace AI meaningfully in their day to day. Until AI achieves these mainstream adoption the and demonstrates a return on investment to the companies that have already bought into AI, valuation remains speculative. That means prices haven't been converted to profits. The products aren't being converted to, real world sales. And this gap clearly represents AI bubble. Moving further, Elon's 1 trillion pay deal is conditional on multiple items. But the push for what Elon is doing to United States to have the chip fabrication industry is a very strategic and smart move. This diversifies the supply away from Taiwan and reduces the global risk. While currently TSMC has the Taiwan office, and that is mainly headquartered to provide the chips that the whole world uses, especially Max 7. Now just imagine something happens to that factory will lead uh, to a global crackdown of all the chips, and the Max 7 goes down the drain then and there. While Elon Musk's vision is sound, it doesn't solve the near term problem. We are still dependent on Taiwan for its advanced chips, and that dependency creates both a geopolitical and supply chain issue, and this is a direct systematic risk for the AI growth. Moving further, the Mag 7 companies trade at a significant premium. The market is saying these companies will grow earnings sustainably faster indefinitely. Much of the growth is already priced in. Nvidia's valuations jumped 200 billion in a year, largely to the sentiments of what they are providing to the industry. The market is pricing these as supply constraints disappear, competition doesn't emerge, and geopolitical risk doesn't matter. Well, if market is pricing based on all these elements, they're just blinding themselves. Let's wake up to reality. The reality is you will have competition, you will have geopolitical risks, and you will have supply chain constraints that I just mentioned. Moving further, lessons from the recent past. As Howard Marks, I hope I'm spelling it right, in his latest memo, talking about how the worst loans are made in the best times. We are obviously in a bull market. The capital is cheap and fear is driving the decisions. Historically, that's what fraud thieves come up. First brands. The founder fraudulently secured billions in financing through fake invoices and double pledging. The same goes with Tricolor Auto. Now, the main point that I want you to take away is many companies claiming revenue are likely to overstate it. When they don't have revenue, they just come up with circular revenue, financial engineering, plain and simple. Due diligence is highly critical. Assume fraud until it's proven otherwise. Scrutinize every statement of the financial statements obsessively, every cash flow, every profit. Make sure you do your research. Next, based on the technology cycles and the market cycles combined, I have come up with an insight. Currently, we are at an all time peak, and there is a significant correction that's yet to happen on a regular basis, is what I'm guessing. Now, the 2025 recent past was a peak, though there were multiple corrections in and out. Over the next 2 years, this is what I see that can happen. As the companies increase their AI adoption, valuations will show the grounded reality. This is more likely to be a prolonged correction rather than a straight off crash. The risk of this timeline can change based on quantitative easing and how the sovereign bank increases or decreases their exposure to AI companies. Now, when I say quantitative easing, I want to tell you about the recent news of how Trump is taking the money saved from the tariff and giving it back to the people. Well, of course, that is good, but that is essentially quantitative easing, and that is indirectly changing the way the markets go forward. Well, I'm not the judge of that, but I want to see how that plays out in the future. Though that is currently not yet finalized, it's still in a bill. Anyways, the final takeaways. What should you be doing as an investor, as a retail investor, or any of the sorts? What should you be doing? Well, we need to first understand the valuations and what is the current market conditions right now. We need to go back to the fundamentals of the valuations and investments. Look at what's actually driving the company. What's the debt level and where are the revenues coming from? Hedge yourself, hold cash, hold gold, and read every line of your cash flow of the company. Make sure it's coming from the external customer. And all of this is for educational purpose and not an investment advice. And I want you to take it that way and leave any of your comments. So thank you for your time, and I'm happy to take any questions. Thank you.